The EU needs massive investment to revive its lagging economy. Welcome to Market Insight, I'm Ramzan Karamali. Well, that was the verdict of former ECB chief Mario Draghi. He was asked to put together a report for the European Commission. He said an additional 750 to 800 billion euros per year of investment was required, and that the bloc needed a far more coordinated industrial policy. Meanwhile, according to the Sentix index, investor morale in the Eurozone fell for a third consecutive month in September. All this news comes in a week when the European Central Bank is expected to cut interest rates on Thursday. But what difference can it hope to achieve by doing so? Well, to help answer that and more, I'm joined by Jane Foley, Head of FX Strategy at Rabobank. Jane, thanks so much for joining us. So how do you assess the health of the European economy? Is it a case that Germany here is the real problem?
Well, certainly, if we look back through the course of this year and last year, then we see that the German economy really is struggling. In fact, if you look at the last PMI data, well, Germany could re-enter technical recession as soon as this quarter. So, yes, Germany, of course, it's fronting China. China is having a lot of its economic difficulties, and that is coming back through the trade route into Germany. But, of course, it does have other structural problems as well. Of course, the loss of cheap Russian energy just being one. The less availability of labour being another. So Germany is a significant issue. Certain other countries with a more services sector base have fared better, but certainly Draghi's report is very uncomfortable reading, raising a number of structural issues facing the whole of the European economy and suggesting that Europe needs a huge amount of investment really to raise productivity so that going forward it can really continue to afford its social services system.
Well, the markets are expecting a 25 basis point rate cut on Thursday from the ECB. Do you agree with that, and why?
Well, I think that is fair. We have seen inflation broadly coming lower in the Eurozone region, and another 25 basis points rate cut certainly seems to tick that box. That a slowing economy coming with inflation coming down could do with an interest rate cut. But of course, we also are very aware that again, it's that sticky services sector inflation that's probably going to stop the ECB from giving us any clear forward guidance as to when that next interest rate cut can come. We are expecting another one before the end of the year, certainly, but I don't think we're going to be given that guidance. I think instead the ECB will tell us that it's going to remain dependent on that economic data, particularly, of course, that services sector number.
Well, let's turn to the UK now. And on Tuesday, we get the latest jobs and earnings data. What are you expecting, and what could this mean for the Bank of England and their policy decision next week?
Well, we have seen a new survey, private sector survey, indicating that the labour market is slowing in the UK. Now, we have had a very tight labour market in the UK. Again, the same theme about sticky services inflation in the UK comes from labour market tightness and sticky wage inflation. So a loosening in the labour market, if you like, is good news for those expecting or hoping for the Bank of England to cut interest rates. But we have too much services sector inflation to expect that the Bank of England can cut interest rates in short order. And we've just had recently in August one interest rate cut from the Bank of England. I think it's far too soon to expect another in September. But certainly it seems that we could see one perhaps once a quarter at this pace, dependent on that wage data. And certainly if that wage data were to be softer than expected this week, that would raise hopes perhaps a more aggressive pace of Bank of England rate cuts.
Well, let's turn to the US now. And are you optimistic about a soft landing prospects there for the economy? We've had non-farm payroll on Friday. We've got CPI coming out later on this week. Is there any hope that the US actually could completely avoid a recession and grow pretty smoothly going forward?
Well, our central view for the US here at Rabobank is that we will in the US see a very mild recession, but we only think there will be a 25 basis points rate cut in September. We're certainly veering on that path. That said, we do think that there could be consecutive interest rate cuts from the Fed. So between September and January, that would give us 425 basis points moves. But of course, the US is still data dependent, and there is a lot of important data to come starting off later this week with that US CPI inflation number. And that, of course, is going to feed that debate as to whether or not the Fed could cut more than 25 basis points, perhaps a 50 basis points move later this month.
So with your prediction of 4 rate cuts to come, the US dollar has been under pressure recently. Would it come under more pressure then?
Well, there is a fair amount in terms of rate cuts already priced in to the US dollar. And of course, we have been talking about some of the structural weaknesses facing the Eurozone too, and the fact that the ECB will be cutting interest rates again. But we've also got to remember that perhaps one of the biggest drivers for the US dollar before the end of this year will, of course, be the outcome of the US election. And certainly if we were to see a Trump victory, given his threats of tariffs and given that he wouldn't need Congress to push through with those, that would be more inflationary. That could mean that the Federal Reserve's interest rate cutting cycle could be cut short next year, and that would be dollar supportive. Of course, a Harris victory could mean a softer dollar. So again, we need to see what that election is going to come through with.
Jane Foley from Rabobank, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.